Good afternoon, ladies and gentlemen. My name is Robert Rayburn here at Life Pro Asset Management. It is August 5th of 2022. Again, it's hard to believe that we're already in August and that there's just a month left of summer. Unless, of course, you're in Southern California, then it's kind of always summer to some degree. But nevertheless, what we want to do this week is continue to focus on some of the short-term trading conditions that we've seen really markedly improved since mid-June. And we want to understand, does this have persistency? Does this have value? And is growth leading other areas of the stock market? Because that's kind of the area that we really focus on. So we're going to go through all of that this week. The title of this week's presentation is The Importance of Discipline. And we've really had a nice recovery here over the last 6 to 8 weeks. And what we always want to do after things start to recover, and of course, without a doubt, we can have another bout of not just pessimism, but another bout of volatility between now and the end of the year. In fact, it's certainly guaranteed that you're going to have some volatility in any given month, especially right now. That said, when you go through this period of recovery, you want to look back and say, did your advisor hold your hand, keep you calm, keep you steady, or were they also a source of the panic? And I can proudly say that, our advisors here at Life Pro Asset Management, I think have done a really, really good job going through this period of volatility and really helping their clients navigate the uncertainty. And it's not easy, right? And I just want to really thank our advisors and their clients for really staying the course from January through to really mid-May, where things were things were volatile, and no one likes to see their account values go down, but we have a ton of work to do. But we're going in the right direction. We're recovering strongly, and I think a lot of the companies that we own are getting better. You're seeing it in the earnings reports. Again, we're in the very early innings of this recovery, but at least we believe that we're in the early innings of this recovery. But nevertheless, I think it's important to look back and make sure whether your advisor was a source of stability. And so I just, again, want to really thank our advisors and our clients for their leadership and a steady hand through the first few months of this year, which were certainly definitely quite volatile. So what are we going to go through this week? What do the employment numbers say about recession fears? Is the stock market breadth expanding or contracting? And last but certainly not least, I'm going to review some of those short-term trading conditions, as well as where we're at with some of the lead inflation indicators that we like to look at. We're going to specifically focus on gasoline and oil and some of those commodity cost pressures this week. Recession. You open the newspaper, recession. You turn on the TV, recession this, recession that. I just have one question. Does this look like a recession? This week, we got the non-farm payrolls. 528,000 new jobs were added in the month of July. The gains were broad-based, whether we're talking leisure and hospitality, which is not too shocking if you went to the airport lately, but then construction, manufacturing, retail. Retail has not been great, especially if you own retail stocks. Across the board, strong employment gains, healthcare, government, transportation, and warehousing. You name it, you had strong employment gains across the board. Unemployment rate fell to 3.5%. And you saw those average hourly earnings, really continue that growth of 5.2%. And which, again, there's that negative narrative around people making more money and driving inflation. But let's keep it simple. When people are finding jobs, when people are making money, it's hard to call this a recession. And I get it. It's very fashionable to talk about recession right now. But no matter what you feel, politically speaking, the truth is that these are good numbers. And, we want to invest around numbers, not around rhetoric. And so the other question, of course, is if there is a recession, what do you want to do? And the good thing here is, Yes, the economy is slowing down, and that is a healthy thing. You want the economy to slow down because it was overheating before. So it's slowing down. Those inflation expectations are rolling over. It's driving some recession fears. Although we've been very consistent here in saying we think the economy is in a slowdown, not a recession, because of those rate of change recovery numbers we saw off the pandemic. So we look at this chart of the week. What do we see here? When do you want to buy stocks? Believe it or not, you want to buy them ideally during a recession. So when you see an official recession be called, those forward return indicators historically on the S&P 500, 12.5% 6 months after a recession has been called, 28% a year later, and 45% 24 months later. So I get it. Recessions are scary, but that's when you buy stocks. That's not when you sell them. We got to stay disciplined. And we continue to believe that despite the rally over the last 6 to 8 weeks, we are still carving out a long-term bottom in our opinion. And we see it in the numbers. So we call it the post-apocalypse trading environment, post-apocalyptic trading environment. And what do we mean by that? As fear peaks, we believe the markets are starting to transition from that sell the rip mentality, which was really what we're gripping the markets between January and mid-May, to suddenly a mentality around buying the dip. Why? Because every time the market dips, it gives an opportunity for those investors that maybe missed the top half of the first inning to start getting into the game at the bottom of the half of the first inning. Or maybe you missed the first inning, but you still think there's 8 more innings to go, and you get involved in the top of the second inning after a dip between the first and second inning. So every time we're getting these dips, the mentality is shifting to, hey, I got to get into the game. And we believe that is the answer. You got to get into the game. And so what we saw here is back in 2020, the percentage of stocks that were 20% off or greater from their peak. In other words, the percentage of stocks in bear markets was about 93%. This time around, it hit about 73.4%. So again, a very, very, very high number. So what does that mean? Historically speaking, when the percentage of stocks that hit a bear market, in other words, a 20% drop off their peak, are between 53.9% of the S&P 500 and 97.8% of the S&P 500, when you're in that range, that is the best time to buy stocks. That is when we see the forward 3-month returns around 7.5%, and we advance 12 months later, that's about 20%. 20% returns when you got over 53% of stocks that are 20% off or greater from their all-time highs or from their recent highs. So a very important point that we all want to consider here is we get it. It's scary out there. It's very volatile. There's a lot of talk of recession, and there's a lot of stocks that are off 20% or more from their highs. That's when you buy stocks. That's not when you sell them. Remember, when you sell because you're scared, that's really, it's like taking a painkiller. It feels good in the moment, but it causes a lot of long-term damage. And we're fairly certain that as markets recover, there's going to be a lot of regret out there from people who sold in May, sold in June, were advised to be fearful and rush to the hills. That's not an investment strategy. That's just a chicken running around with its head cut off. So we want to be disciplined investors. So what do we see? We see that breadth is continuing to improve. After 73% of stocks reach S&P, or sorry, after 73% of stocks reach bear market status, that's usually a pretty good sign that we want to get involved. So there's only been 3 other times that stocks have been more oversold than they were back in May and June. And that was, of course, March of 2020, March of 2009, and the post-dot-com bubble. All of those times were great moments to get involved with stocks, at least for the next few years. And so we see, again, the percentage of stocks here that are above the 50-day moving average, again, have crossed that 75% threshold that we always like to pay attention to here. Again, we can see here, historically, this has only happened a few times after an extreme bottom where only, call it like 1 or 2% of stocks were above their 50-day moving average. Those are good times. This is good times to buy stocks. Those are times when we see a big positive breadth thrust in the market, and we're seeing it today, kind of confirming that there is a potential for a very strong multi-month, perhaps multi-year bottom being put into place for stocks. Now, all that's great. That doesn't mean we're just off to the races every single day and there's not going to be another down day. We're going to have what's called resistance. How does resistance form? Resistance forms because there's a lot of people out there that are sitting on losses. And as things rally, they are offloading their inventory thinking, hey, this isn't the real deal. This is a bear market rally, so I'm going to sell as things go up. And that causes resistance points, right? So right now, that 50% retracement on the triple Qs relative to the S&P 500 is just about, call it 10% or so, not 10%, probably like 7 to 8% from where we're at today. And then for semiconductors relative to the S&P 500, we're basically right there. So it's going to be very interesting to see how the semiconductor space reacts relative to the S&P 500 here over the next week. But certainly we're seeing very strong action in areas such as biotech and software and certain areas of consumer discretionary, areas that were very out of favor here over the last year or two. And the other thing that we really like here, ladies and gentlemen, is that credit markets are continuing to heal, right? One of the big red flags that can happen, and again, this expansion, this widening out of credit risk was nothing, absolutely nothing compared to 2008. So when we saw the fact that consumer sentiment was worse in 2008, and then we looked at the credit markets, we're like, come on, give me a break. That said, after the recent widening of the credit markets, what we've seen is that implied credit spreads, implied credit risk within the bond market has started to come back in. In other words, as implied credit risk falls down, that's a good thing. As it goes up, that's a bad thing. It implies more risk. So again, the fact that it's coming down is a very, very, very good thing. And then, of course, gasoline. I mean, now before, I think 3 months ago, we were talking about how gasoline was spiking. There's a crisis going on. Now we're kind of throwing out this idea of the great gasoline collapse from 502 a gallon to 411 in literally a month. And if you look at the gasoline futures, they're absolutely plummeting right now. Now, what can this be all derived back from? The drop in oil, right? Oil has now reached $88 a barrel. Back at $120 when we were talking about the potential for an oil bear market, people were certainly looking at us like we were out of our minds. You have a war in Europe. You got inflation in the U.S. Because of high nominal GDP growth. You have a shortage in production, both in the U.S. and Saudi Arabia and other OPEC countries. How on earth can a bear market even get started? When all of that is baked in is typically when you see a bear market start to perk its head a little bit. Why? Guess what? There's another factor to the oil demand equation, or the oil price equation, and that is demand. And so as the economy is softening, people are driving less. That's that's an important point to consider. So again, since that June pivot, and we've used this chart a few times over the last couple of weeks, what do we see? The Fed gets tough in inflation in June, stocks bottomed out. Interest rates topped out. Inflation expectations topped out. Commodities peaked and basically have collapsed since mid-June. We see this was the pivot low, at least so far, since mid-June. So going back to our factor matrix, when we're getting accelerating growth, rising rates, and rising reflation, basically, when you're in this type of environment where growth is moderating, but it's still positive, inflation and interest rates are steady to falling back. We've seen interest rates fall from 3.5% to about 2.85% today, off its recent low of 2.59 or so, but again, significantly off that 3.5% level. Those are times when you want to shift out of value stocks into the growth stocks. So the bottom line is, despite that market bounce, the media remains fixated on the fears of recession and the Federal Reserve and hiking interest rates. So that kind of tells us that the markets could continue to climb that wall of worry. Commodities continue to collapse. that is definitely easing back some inflation pressures and inflation expectations, which the Fed really pays attention to. Yes, the labor market was strong, but guess what, ladies and gentlemen? A strong labor market, people working, people making more money, that's not a bad thing. And then lastly, of course, as economic growth slows, we believe investors will pivot toward those stocks that can grow in a low growth environment. Thank you again, ladies and gentlemen. If you have any questions or concerns, the number is 888-543-3776. Or of course, as your primary source of information, please feel free to reach out to your local advisor. Thank you again and have an absolutely fantastic weekend.